Okay, this is the 2019 racehorse question. I'm not sure how this will work out. I've sort of done it in advance and try to make a presentation for it. It's obviously trickier to do than any of the other questions to make a video for, but we'll give it a go. Okay, so just the things to look at. Okay, maybe highlight when you get this in your leaving cert. Just highlight the industry they're in, because we'll need that for the sector. So it's the renewable energy industry. So what do we know about that? Well, it's a growing industry. We're all more energy conscious. There's grants available, things like that. Next thing we should highlight is the share price. Now that'll be down here at the bottom. The current share price is €1.35. So that's something to be aware of. And then two things I would work out, maybe on a workings page that we'll use. I'll work out the preference shares. So 8% of 250,000 is 20,000. We'll need that in some of our ratios. And I'll just check my interest for the year. 6%, so 15,000 is my interest for the year. Just make sure then that the information in the box is from last year. There was 1 year, I don't remember what year, 2008 maybe, where it was forward looking. So if this was 2018 here, you were given the projected ratios for 2019, and that would cause, well, it doesn't cause any confusion. It means it just puts a slightly different focus on the report that you end up writing. So just these things in the box here, make sure, like we need to be nearly ticking these off as we go, that we're using those that we use all of those in our report. If they're given to us in the box, we really should be using them in our report somewhere. Okay, so just take that into account. What are we asked to do? So apart from our ratios, just maybe highlight whether it's shareholders, banks, whether the shareholders are issuing new shares, whatever it might be. So it's just a report on if the ordinary shareholders will be satisfied with performance, state of affairs and prospects of the company. So somewhere in your answer you have to put in that yes, they will be satisfied, or no, they won't be satisfied. And you'll have a sentence, yes, the shareholders will be very satisfied with the performance, state of affairs and prospects of the company, or no, shareholders would be very unsatisfied with the performance, state of affairs and prospects of the company. Okay, so just be aware of those. And we need to then use those headings: performance, state of affairs and prospects. So that scaffolds our answer. And then there's part C, but we'll come to that at the end. Okay, so we'll be given our 5 ratios to work out. Now they should be very straightforward for us to do if we've learned them off. So we know our first one is going to be one where we have the answer and we have to work out something within the ratio. So we're asked to find cash sales if the period of credit given to debtors is 1.5 months. So the formula for that is debtors by 12 over credit sales. So we know that debtors by 12 over credit sales is 1.5 months. So in our question, we're told that debtors 78,000. So we have enough information from that to work out our credit sales. So 78,000 by 12 divided by credit sales is 1.5 months. So if we just work out that sum, 78,000 by 12 is 936,000. So 936,000 over credit sales is equal to 1.5 months. So you're all brilliant at maths, as you tell me the whole time. So if you just cross multiply by the equal sign, credit sales by 1.5 months will equal 936,000. And then obviously if you divide that 1.5 across into the 936, you'll get credit sales is equal to 624,000. Okay, so from that, you weren't asked to find credit sales, you're asked to find cash sales. So do you have enough information? Well, if you go up to the top, you'll see that total sales is 960,000. Okay, so there's only 2 types of sales, credit and cash. So if total sales is 960 and credit is 624, well then 960 is 624 plus cash sales. So cash sales is 960 minus 624. So it's equal to 336,000. Now you don't have to write all that down. Just put that down for the sake of a set of notes on the question. Okay, so that's your first one. Each of these were 10 marks, so you've got 10% of the question out of the way, and over 3% of your leaving cert. Second one, dividend yield. Now, the formula for dividend yield is dividends per share over the market value of one share. So we know that this is going to be a two-part one because we have to work out our dividends per share ratio. So dividends per share, which is ordinary dividend over issued ordinary shares. And of course, ordinary dividend in the context of this is going to be total dividend minus preference dividend. That's why I said it's a good idea to work out your preference dividend here. 8% of 250 is 20,000. So your total dividend paid is 55. If 20,000 of that is preference, well then 35,000 is ordinary. So it's going to be 35,000 over issued ordinary shares. It's 500,000 here. And that's equal to 7 cents. So that'll be 0.07. Now I've put it into cent by multiplying by 100. You don't have to. You could keep that at 0.07, and then it will be 0.07 over 1.35 by 100, and you'll get the same answer of 5.19%, or 7 cent over 135 cent. What is important is that you keep them constant. So if one is in cent, they're both in cent. So 5.19% is your answer for number 2. So dividend cover. So dividend cover is net profit minus preference dividend over ordinary dividend. So it's the number of times you can pay your ordinary dividend out of your profits. So net profit for the year is 90,000. So it's net profit after interest. So it's the one after the interest. So 90,000, take away the preference dividend of 20,000 is 70,000. And your ordinary dividend is 35,000, which we know is the total dividend 55 minus the 20. So it's 35,000. So 70 over 35,000 is 2 times. Okay. So 10 marks for that, one of the easier ones. Number 4, return on capital employed. So return on capital employed is net profit before interest. So net profit before interest means you add back on the interest if it's not done for you. So it's net profit before interest over capital employed, and for anybody who doesn't know, thinking of Mark Shield, capital employed is the last number in our balance sheet, 1087. So it's made up of your debentures, your capital and reserves. So net profit plus interest over capital employed, obviously it's a percentage, so multiplying by 100. So 90 plus 15 over 500,000, whatever answer we get, we'll multiply by 100, and that's 9.66%. Okay, so that shouldn't say 500,000, that should say 1087. Jesus, let me just change that. The rest of it is right. So so the last one then is your price earnings. So the question asks us to work out its price earnings, so which we know is the period or the amount of time it takes a share to recover its price based on present earnings rate. That would be another way of asking it. Instead payout rate, you would use dividends per share. But it's earnings rate, it's earnings per share. So price earnings ratio is the price of one share over the earnings per share. So the market value of one share, which we know is €1.35, over the EPS, which we have to work out. So earnings per share, net profit minus preference dividend over issued ordinary shares. So 90 minus 20 over the issued ordinary shares, 500,000. So that's 14 cent. Or again, you could have it 0.14. So again, keeping things constant. Market value of earnings per share, so either 1.35 over 0.14 or 135 over 14. Either way, you get 9.64, and it's important that you know that that's years, because the price earnings ratio is how long it takes for you to get your money back. So 9.64 years is your answer there. So that's your 50 marks. Now I would fully expect everybody to get 50 out of 50, and then we're trying to get the other 50 in our report. Okay, so our report indicate if the ordinary shareholders will be satisfied with the performance, state of affairs and prospects. So as I said, we're going to look at the question, and the way it asks determines the layout. So in this case, we're asked from the perspective of shareholders, and we're asked to answer in the context of performance, state of affairs and prospects. So we're going to keep those as our three headings. And that's just, as I said at the start, you should give an opinion. Okay, so in this case, I'm going to say, because I've done this answer out and I put this back in, the shareholders will be very satisfied with the performance, state of affairs and prospects of the company for the following reasons. Now I think I'd write that in regardless. And then I would, I could go back and change very satisfied to not satisfied or whatever it might be. Okay, so we're going to look at performance first. Now, performance is made up of two areas. So it looks at profitability and it looks at dividend policy. So in our performance section, we have to write about those two areas. Now, profitability. Now, I just followed, when I did this report, I just followed the reporting on accounts document for all of this. So, and then at the end, I just compared it to my marking scheme to make sure I had everything in, and I did. So following my report would have gotten us 100%. Okay, so for shareholders, they're quite detailed. For debenture holders, dividend policy isn't that detailed. Profitability is sort of the same. So for profitability, what did I say? So my first thing is it a profitable company? So Shannon PLC is a profitable company. They're always all profitable companies. So this time they made a net profit of 90,000. So we can say that they're a profitable company, 90,000. Okay. Next thing, I need to write more about that profitability. I need to write about the return on capital employed and return on equity funds. So for the return on capital employed, well, I worked it out in my answers earlier that it was 9.66%. Now I need to compare that to last year. So last year's is 5.8%, so it's increased quite a lot. So we can say that it has increased from 5.8%, and we need to say that that's a positive trend. Okay, so now what do we do then? We compare that to the risk-free rate of return. Now in Ireland at the moment, the risk-free rate of return is 1% roughly, pretty much zero actually, but we can say it's 1%. So it's well above the risk-free rate of return available at present of around 1 to 2%. It's good. Obviously shareholders will be happy with that. Okay, and I should have put that in, shareholders will be happy. Okay, so it's also above the borrowing rate. Now the borrowing rate is your debenture rate. And if it's above the borrowing rate, they're borrowing money to make more money than they're borrowing, if that makes sense. So that's a good use of resources. So it's above the cost of borrowing, which is an efficient use of resources. If they're borrowing money and they're making a profitability less than their borrowing rate, that's not a good use of resources. So you should be more profitable than that debenture rate. So Shannon PLC has a return on the shareholders' funds of 17.87, well above the risk-free rate of return. So we can say they'll be very happy with that. So we know they're going to be happy with the positive trend. Okay, and that's all we need for profitability. I have stuff in about price earnings ratio. It's no harm to put it in there, or you can use it later on in the prospect section. I would use it later on in the prospect section because that's what all the marking schemes do now. Okay, so second one, dividend policy. So we need to talk about dividends per share, which is given to us here. we need to talk about dividend cover and dividend yield. We're definitely going to have to talk about the three of those because they're given to us in the ratios box. I'm also going to put in overall return because I can talk about overall return because that's dividend yield multiplied by dividend cover, so I can work that out. So I'm going to follow my document, my reporting on accounts document. I'm going to start off by saying that the dividend per share is 7 cents, which I worked out in part A. I didn't have to go back and work it out again, and it's increased by 2 cents from 5 cents per share, which is a positive trend. So every time something positive happens, you should say the shareholders will be happy with it. I can move on then and talk about my dividend yield. So 5.19, which I worked out in part A, and that's up from 4%, which is a positive trend. And again, I'm going to put in that shareholders will be happy with this. Now, I think within these, you should pretty much try and define what the ratio means. So the dividend yield is the real rate of return available to shareholders. So that's the proper rate you're getting, and it should be above the risk-free rate of return. So shareholders will be happy with this as it's above the risk-free rate of return of 1 to 2%. So that's what we say for dividend yield. Now for dividend cover, interestingly enough, it's the same. I remember we worked it out, it's 2, and it's 2 times this year. Now, again, I just followed what I wanted in my report. The dividend cover is 2 times, so there's no change. And what can we say? Well, shareholders would like, that might be a bit high basically, so shareholders would like more of the profits retained in the business to fund future expansion. Okay, that's always a good line to put in. If dividend cover is low, maybe that they might want more of their money. You can also say they're very happy that much of the money has been paid out in debentures and much of the profits, but it could be a good idea to keep some money to fund future expansion. So I like that line, and we're going to use that quite a bit. So that's our dividends done. Oh, sorry, I also put in the overall return. Overall return is div yield by div cover, so 10.38, an increase of 8%. And again, I could say that shareholders will be happy with that. So that's our profitability and dividend policy. So that's our performance done. So we move on to state of affairs. Now, state of affairs, you should write about liquidity, gearing and interest cover, and investment policy. There are 3 for state of affairs. Depending on if you're asked from a banking point of view, this would obviously be more important. Okay, so for liquidity. Okay, liquidity. Now, in the notes, I wrote about current ratio. Now, it's no harm to write that the current ratio is, but I have a big spiel on it, but they never give you the current ratio in the question, so I just skip to the asset test ratio part. Now, we have to work it out. So asset test ratio, current assets minus closing stock, so 150 minus 60, so 90,000 divided by 84,000, which is 1.07 is to 1. Okay, and that's an increase of 0.86 from 0.86 is to 1 last year, which is a positive trend. Now, it should be above 1 is to 1, so we can say the shareholders will be happy because it's above the ideal minimum of 1 is to 1. Okay, now from there it's a good idea to say what it means. So we can say Shannon doesn't have a liquidity problem as they have €1.07 of liquid assets for every €1 of short-term debt. If they fall below, so in some of the questions where safe was 0.86, we'd say they'd have 86 cents of liquid assets for €1 of short-term debts and may have difficulty paying their debts as they fall due as a result. Okay, but they won't have any difficulty paying their short-term debts as they fall due, which I could have put in. Now, why would shareholders want it to be good? Well, generally, good liquidity allows companies to pay reasonable dividends. So if they've got plenty of cash, they can pay dividends. Okay, so that's our liquidity. Our gearing and interest cover, in your notes, are separated. In marking schemes, they're always together. So what can we say about gearing? So we worked out the gearing, debt capital over equity capital. debt capital over capital employed. So the debt capital is 250 plus 250, so 500,000 over 1087 is 46%. So they've got a gearing of 46%. Now below 50% is good. So it's down from 56% last year. So it's one of the ones where if it goes down, it's a positive trend. So we need to know that the decrease is a positive trend. So they've gone from being highly geared, and highly geared means over 50%, to being lowly geared, under 50%. So what does that mean? Again, if you explain it out, gearing is how your business is financed. So if you're lowly geared, the company is more financed from equity than debt. Now, I didn't put this in the notes, but I might have a look at it. But just like the liquidity one, low gearing increases the chances of dividends being paid to shareholders. Okay. The interest cover is net profit minus interest over interest. So the interest cover 7 times 2018. Net profit plus interest. Which is 105 over 15, which is 7 times. And that's an increase from, that shouldn't say 4.3%, that should say 4.3 times in 2017, and it's a positive trend. And again, you should always explain what it is. So net interest cover is the number of times that interest can be paid out of profits, and the rising number increases the chances of dividends being paid to shareholders. Okay, so you can say that for any of these ones, for any of the liquidity and gearing and interest cover ones, positive trends increase the chances of dividends being paid. Okay. Investment policy. There was no marks for this in the marking scheme, but it was mentioned, so it is one of them. So investment policy, just compare what the investments are worth versus what they had cost initially. So the market value is 250 and they're worth 210. So we can say investments have a market value of 250. These investments had originally cost 210,000, an increase of 40,000. Now, you should put that in as percentage terms. 40,000 over 210 by 100 is 19%. So 19% growth in investments generally shows that the management are good at investing. So the management have an effective investment strategy that would please shareholders. And that's all you have to say on that. Obviously, if they've gone down, you'd say the opposite. Now, the prospects. We know the prospects, you need to write about sector and market value of shares. So everything's positive, right? So far. So the sector should be positive as well. So with the sector, you're saying you've got to come up with positives for it. So the renewable energy sector is positive. It's growth sector because consumers are more environmentally conscious. So we can see that the thing is growing. And also the government are providing grants for energy upgrades. So that's in the short term. Try and go to the long term then as well. So always think short term and long term. So in the long term, the move towards renewable energy will grow. So prospects are very strong. I didn't really know what to say for it. So, but I know you should always write short term, long term. So short term, it's growth sector. Long term, that movement towards renewable energy is going to continue to grow. Okay, so that's all really. And then the market value of shares, it's the share price and the earnings per share. So the share price has gone from 125 to 135. Okay, 10 cent, and say that it's an 8% increase. And what does that mean? Well, there's confidence in the business. Then throw in your price earnings ratio there. The price earnings ratio was 9.6 years, and we've seen it's improved from 12.5 years. So it's the number of years it takes to get your money back from your investment. So again, explaining it. So shareholders will be happy with that. So it shows better value investment from the previous year. So that's one of the ones where if it goes down, it's good for shareholders. Okay, so that will get you to 40 out of 40, or very, very close to it. Okay, in the last 10 marks, Part C, Shannon PLC is considering acquiring a solar company, Generate, in 2019. Generate has supplied the following balance sheet information. So closing stock, creditors, debtors, expenses accrued, which is expenses due, accruals are dues, expenses prepaid, and bank overdrafts. And this is based on the information, calculate the current ratio and calculate the asset test ratio. So it's basically asking you, do you know which of those are assets and which are liabilities? All right. So the assets are closing stock, debtors, and expenses prepaid, money owed back to us. The liabilities are creditors, expenses due or expenses accrued, and bank overdraft. All right. So from there, current assets. So as I said, I've gone through what they are. I can do the numbers. So the current ratio is all of your current assets, so 47 plus 39 plus 13, divided by all of your current liabilities, 45 plus 15 plus 16.5. That gives you 1.29:1. And of course, that's below the ideal of 2:1. And it's a good thing to say that. Okay. The asset test ratio doesn't include your closing stock. So debtors plus expenses prepaid, 39 plus 13, over all of your current liabilities, 45 plus 15 plus 16.5, and that's 0.68:1, which is below the ideal 1:1. So they're thinking about buying a company with a liquidity problem. Now, there's nothing really wrong with buying a company with a liquidity problem as long as you have a way of fixing that liquidity problem. So it's important to analyse the liquidity position for Generate Limited because they need to know what they're getting themselves into. So we've calculated the figures. It's only worth 10 marks. The figures are probably worth 6 of the 10 marks. So the report's going to be very short. We can say they're not liquid. They may have difficulty paying their short-term debts as they fall due, and therefore they face the potential bankruptcy. So Shannon needs to be careful when buying a business with poor liquidity and will need to have strategies to fix that. So they need to have a strategy to get their liquidity in order, and then it could be a good business to buy. Okay, and that'll get us to full marks, or very, very close to full marks. It'll get us well over 90%. So hopefully that's of some use to you. I'll keep working back on them, probably do one every couple of days over the Easter, and we'll see you in a couple of weeks' time.